Properly structured life insurance can provide tax-free income through policy loans, but how does that work? Hi, I'm Matt with Carlin Financial Group. For the best retirement information and to help make sure you don't outlive your money, subscribe to our channel and ring that bell to be notified when we post new videos. Certain types of life insurance can build a cash value that can be accessed through loans while keeping the policy active. However, it must be structured properly, and you need to understand just how a policy loan works to determine if it's right for you. To take advantage of policy loans, you must first invest in an insurance policy that builds cash value. And typically those are universal life insurance, indexed universal life insurance, or whole life insurance. Term life insurance policies do not accumulate any cash value, so therefore they can't be used in this way. Now, today we want to discuss how life insurance loans work in general. We'll explore the different types of insurance mentioned above in an upcoming video. Borrowing money from a life insurance policy can be an effective way to help manage taxes you'll pay in a given year, and it can be set up to send you tax-free income over a span of years, possibly your lifetime if managed properly. Requesting a loan is fairly simple. You fill out a form provided by the insurance company requesting how much you want to borrow and for how long. But there are terms to these loans that you need to understand. Now, one of the most important things to understand is that you are not borrowing your own money. The insurance companies issue the funds as a loan. Here's an example. Let's say you have $100,000 in cash value in the policy and you borrow $10,000. You submit the paperwork, the insurance company issues the funds to you. You won't see that $10,000 taken out of your cash balance, and you can still earn interest if the underlying investment performs. However, you now have a loan balance on your account. The insurance company charges interest for the loan, and any unpaid interest will be added to the loan balance each year. Now, you do have flexibility in paying the loan back. Technically, you don't have to repay it, but that means the interest will continue to accrue and add to your loan balance. And if you aren't depending on the policy as a legacy planning tool, or you aren't really concerned with the death benefit, that might be an option for you. If you do repay it, there is no fixed repayment schedule. You can make payments at any time and in any amount that you choose. If you repay it, the full benefits of the policy are restored, including the full death benefit. If you have an outstanding loan balance on your policy when you die, the death benefit would be reduced by that amount. Also understand, if the loan balance gets too high, the insurance company could surrender the policy to pay that off. If you take loans and the policy stays in place, meaning the loan balance does not get too high and the policy remains in force, your withdrawals will not be taxed. So this can be a great tool to provide tax-free income in retirement. However, as I said before, if the interest is not paid, it will be added to the loan balance, and it could at some point become equal to the policy's cash value and could cause the policy to lapse. If that occurs, a couple of things will happen. The company will surrender your policy, then they will use the proceeds to pay off the loan. In that case, you likely won't receive any surrender proceeds from the policy. So what tax implications could there be if you had to surrender the policy? For an example, let's assume you have a policy with $200,000 in cash value and you paid $90,000 in premiums over the years. If you have no loan on your policy and you decide to surrender it, $90,000 of the proceeds would be tax-free as a return of principal. The $110,000 gain, however, would be taxed as ordinary income. And assuming you were in a 30% tax bracket, you'd pay the IRS about $33,000 in taxes. You walk away with $167,000 after you pay the taxes. But what if you had an outstanding loan? If you borrowed $100,000 and never made any repayments, the interest would compound, and if it gets too high, the policy lapses, the company would surrender it and use those proceeds to pay off the loan. From a tax perspective, you would still owe the tax, but you wouldn't have any surrender proceeds to help pay that tax. So the bottom line, taking loans from the cash value of a properly structured life insurance policy could be a way to access tax-free money during your retirement. But as I discussed, if it's not done properly, there could be unintended consequences. So as with any financial product, make sure you understand how it works before making any purchasing decisions. Thanks for joining me for a few minutes today. I hope this information was helpful. If you have other questions or concerns with this or any retirement issues, let us know in the comments. We'll do our best to answer those in future videos. If you're ready for our help, you can learn more and apply to become a client using the link below in the description. Don't forget to subscribe to our channel so you won't miss out on any future tips. And as always, live today, plan for tomorrow.